What if the biggest reason you're not investing isn't money, but misunderstanding? Because the truth is, the stock market isn't reserved for experts, finance graduates, or people with thousands to spare. It's a system. And once you understand how it works, you can start, even with very little. Let's be real. Most people today feel financially stretched. You might be earning, saving a bit here and there, but between daily expenses and future uncertainty, investing feels like a risk you're not ready to take. So, what do most people do? They wait. They wait until they have more money. They wait until they feel more confident. And years go by without ever starting. Before we go further, a quick note. This video is for educational purposes only. It's not financial or investment advice. Always do your own research and make decisions based on your own situation. Now here's the shift. The goal isn't to get rich overnight. The goal is to understand a system that allows your money to work for you over time. Because if you don't learn how to grow your money, you'll spend your entire life working for it. Let's start with the foundation. A stock represents ownership in a company. When you buy a stock, you're buying a piece of a real business. Not just a ticker symbol, not just a price. A business that sells products, hires people, and generates revenue. If that business grows, your ownership can grow in value too. Imagine a company is divided into millions of pieces. Each piece is a share. When you own one share, you own a fraction of that company. It might be a tiny fraction, but it's still ownership. And here's what most people don't realize. Wealthy people focus on ownership. Everyone else focuses on income. There are different types of shares. Common shares usually include voting rights, allow you to vote on company matters. Preferred shares typically no voting rights, but may offer priority when receiving dividends. This is why they're called preferred. Dividends are payments companies make to shareholders from profits. Think of it like this. You own part of the business, so you get a share of the earnings. Some investors focus heavily on dividend stocks because they generate consistent income. Others focus on growth stocks, companies that reinvest profits to expand faster. So, why do companies sell shares? Because growth requires capital. By selling shares, companies can raise large amounts of money without taking on debt. They can expand into new markets. This process begins with an IPO, initial public offering. This is when a private company becomes public. Early investors and founders may sell part of their stake, and new investors can now participate. But here's something important. Not every IPO is a good investment. Some companies are overhyped. Some are priced too high. So just because a company goes public doesn't mean it's automatically a good buy. Stock prices move for one core reason: supply and demand. But what drives that demand? Company performance, future expectations, news and headlines, economic conditions, investor emotions. The market is not purely logical. It's a mix of data and human behavior. Imagine selling something online. If 50 people want it immediately, you'll likely raise the price. If no one responds, you lower the price. Now multiply that by millions of people making decisions at the same time. That's the stock market. Every trade has two sides: a buyer, a seller. Key terms: bid, highest price someone will pay. Ask, lowest price someone will sell. The difference is called the spread. Now let's touch on something beginners often fear: metrics. One common metric is the PE ratio. It compares a company's price to its earnings. In simple terms, are you paying a high price for low earnings or a fair price for strong earnings? You don't need to master this immediately. Just understand that investors use data to decide what's worth buying. Saving money is important, But saving alone isn't enough. Why? Inflation. Over time, money loses purchasing power. Investing helps your money grow faster than inflation, if done wisely. This is where compounding comes in. You earn returns, then earn returns on those returns. Over time, this creates exponential growth. And here's the key. Compounding needs time. The earlier you start, the more powerful it becomes. One of the biggest beginner mistakes is putting everything into one stock. Instead, investors often diversify. That means spreading your money across multiple investments. Why? If one performs badly, others can balance it out. It reduces risk over time. Here's something most people underestimate: psychology. People panic when prices drop. People get greedy when prices rise. This leads to bad decisions: buying high, selling low. Successful investors learn to stay calm and think long-term. To begin, you'll need a brokerage account. This is your gateway to the market. From there, deposit funds, research companies, start small. You don't need to go all in. You just need to start. And just to reinforce, this content is for educational purposes only, not financial advice. Always do your own research before making any investment decisions. At the end of the day, the stock market is simply a tool that allows you to build ownership, grow your money, and participate in the success of businesses. You don't need to be an expert. You just need to take the first step. If this helped you understand the stock market better, like the video and subscribe. It genuinely helps the channel grow and allows me to create more content like this for you.